You know, people get upset about the day-to-day variations or risk in the stock market, and understandably so. And you might look at it as a standard deviation. The green area is one standard deviation either side. The red is 2. The orange is 3. And maybe we could do a simulation. And in doing so, here's one I wrote. Seems to look okay. And if you wanted to create one yourself, you could do so. Look at line 120. Square root of, turns out it's -2 times the log of a random number between 1 and 0 times the sine of 2 times pi, I stored it earlier, times another random number between 1 and 0. And here are some other examples. You can see a moving average moving through them. And you know what the whole point of this is? It's perspective. Suppose you're on the freeway and you're averaging, maybe on a long trip, anywhere from 40 to 70 miles an hour, at least for me. But on the other hand, at each interval, you might be going 30, 73, 60, 10. So the short interval perspectives are going to probably have more variation than across longer periods of time. So instead of looking at random numbers, look at real numbers. Here's the Dow Jones. The Dow Jones 30s Industrials, noting it's not properly price weighted, but is the granddaddy of them all, and maybe I will also soon be. Here's a perspective across a half year. Here's a perspective across a quarter, 3 months, if you will, and we can keep zooming in. Here's now in daily intervals across a couple of months. And we can even zoom in closer. Here's a 1 month perspective with daily intervals. And we can zoom in even further, noting I got these from big charts on Market Watch. And here we are going back across 15-minute intervals. And now here's a 5-day perspective. We can zoom in even closer. And here's a 2-day perspective now at 5-minute intervals. And of course, we can go in for a 1-day view of the market on 1-minute intervals. Let's go back to our 1-year view. Instead of zooming in, let's zoom out. Here is a 2-year view of the Dow Jones Industrials 30s. We can zoom out further. Here's a 3-year view, and I bet you're probably seeing there must be a point to this as we look at a longer time perspective. And that is, one might presume that returns might be, say, linear function of time, and that is wrong. A return to a security, it's the gain or loss plus income divided by the previous price, and we can compute the mean, compute the variance, standard deviation, and you know what it turns out? It's a function of the square root of time. And this isn't just theoretical. We can see it also in the Black-Scholes call option model. And again, risk is a function of the square root of time. By the way, that 256 is kind of useful because it's almost exactly the number of trading days in a year.